Hey, Kevin here, top 100 financial advisor, two-time author, one-time bestseller. And I want to talk about a trap that I see a lot of new investors fall for, and it's dividends. So in this video, we're going to talk about what dividends are, why they are important, and then some red flags that you want to be aware of. I want to show you where investors can fall prey to a few things and end up with an investment that ends up losing money because they were looking at the wrong things and chasing the wrong things. Before we do, make sure you go to buildingbread.com, go ahead and hit the free class tab, and you'll see two of the classes that I'm teaching almost every day. We're actually looking at adding a class here pretty soon. But right now, these are two classes I teach on the left and the right, and I have a free investment guide for you as well. All this free every day. I'm out here teaching you guys because I know you guys have questions. And we need this is an access thing. I want to make sure you guys have access to quality investment education and advice. So this is free for you guys here all the time. Make sure you share this video with your network, your friends, and your family, so they can also build wealth together with you. Now, let's go ahead and hit the whiteboard. I want to show you a few things here. So I'm going to break down this stock with you here. So first, we know that I'm just going to switch to blue here. This is what's called the ticker symbol. These letters are going to tell you what stock we're looking at. It's going to give us a stock price and some information that's important for us to understand. For example, the symbol F is for Ford. You type in Ford, boom, this is what's going to come up. And this is from Yahoo Finance. You can do this almost anywhere. So F is for Ford, DIS is for Disney, KO is for Coca-Cola, COST, cost is for Costco. And we can do this all day. That's the first thing is the ticker symbol. Now, the second thing here is a price. This means that's $2.52 per share. So to buy one full share, I need $2.52. This is first off a red flag. Anytime a stock is below $5, I'll just write this here. If it's $5 or lower, you want to be a little cautious because I've said it before. Would you buy a MacBook for 99 cents? No, probably not. There might be something wrong with it. Would you buy a MacBook for $200, $300, $400? Maybe so. Maybe that's a steep discount because I know it's worth $1,000. If I'm paying 400, yeah, maybe get a good deal, just maybe. But if it's 99 cents, that's something I should be concerned about. So anytime a stock is below $5, you want to have a little bit of caution and say, well, what's really going on here? So that's really the case here. So that's the first red flag that I saw here. Now, second thing is here. This is the change. So we see that this screenshot was taken on April 3rd. That means from April 2nd to April 3rd, the stock dropped 30% in a day. Now, at the time of this recording, the entire stock market, because of the coronavirus, is down about 25%. But it took weeks to get there. This dropped in a day. This is a huge concern for me and should automatically raise another red flag. So it's below $5 and it dropped 30%, almost 31% in a day. But what some people do is they want to chase dividends. And dividends are payments that if you own the stock, they're going to pay you out at least once a year, or sometimes they'll take that payment and break it up. For example, if you get a $100 dividend, they may say, look, I'm going to pay you $25 in March, pay you another $25 in July, another $25 in October, another $25 in December, for example. What people try to do is say, look, I don't have so much to invest, or I'm new to this. I want to get the biggest dividend payout I can get. So go to Yahoo Finance, they'll go here and say, oh my God, they're going to pay me 41%, a 41% dividend. That's crazy. I can get a lot of passive income and I don't really have to worry about how the stock does. Well, here's the problem. So first, we know here that it's going to pay you the estimation because they're not exactly exact because dividends may change from year to year. So it's going to pay you $1.72, or it is expected. It's expected to pay $1.72 per share. So if I own one share, I get $1.72. That's going to get broken up through the year. So you're really going to get, you're really going to get 43 cents every 3 months if you own one single share. Is it passive income? Yeah, but I mean, so what, right? 43 cents is not a big deal. But some people will just buy into it and say, look, this is what I'm going to do. I want to get paid. Next thing you want to worry about is this is a high number. you may see a dividend that's maybe 4%, 1.5%, 2%, 3%. Those are okay, but 43% is really, really high. And again, red flag, this is a little too good to be true, that if I can own a stock, they're going to pay me 43% in dividends. And when we say that, we mean we're essentially taking this number here and dividing it by this number. So that's where the percentage comes from. That's a lot. And the next thing we know from that, if these two numbers are really, really close, I don't know, man. That's a red flag. There's a lot of red flags here that just don't make me feel comfortable. But here's why: dividends aren't always consistent. They can change from year to year. They can change from quarter to quarter. But also, some companies, depending on the health of the company, they can change a dividend or cancel it altogether. One recent example is Ford. They suspended their dividends altogether. Another example was GE. Several years ago, they cut their dividends. Say, look, we're paying X%. We're going to bring this really, really low because we need to use this money for something else. However, companies like Coca-Cola, companies like Johnson & Johnson have been paying consistent dividends for 50 plus years. So it always depends on what company you're investing in. But first, these are just the red flags. First, we know that this stock, again, it's really cheap. Anytime you get a stock that's $5 or below, that's already a red flag for me. It's probably a penny stock, which means that it's not solid. For example, would I buy a MacBook that I know is $1,200? Would I buy it for $800? Yeah, maybe. Would I buy it for $500? Perhaps. Now, I want to know if this is this a legal laptop? Where did you get it from? Why is it $500? Would I buy it for $99? Absolutely not. Something is probably wrong if I'm buying a $1,200 thing for just 99 cents. So if this company is so great, why am I only getting it for $5.52? And why is it down 30% in a single day? Not a year, because the entire stock market, as of this video, is down about 25%. But it took months to get there. We're talking about January to April, it's down 25%. This happened in a day. That's a red flag. Something is going on with this company, and they might maybe change that dividend. So I want to be careful about that. This could go from 41% to 0.2% real quick based on how fast this company is falling. And they're at $2.52. It ain't much farther to fall from there. So all of these are red flags. But sometimes a new investor can get into this and say, look, I want to get into it for a dividend because they think that dividend is guaranteed. It may not be. In most cases, it's never guaranteed. But a company like this, I mean, that dividend can change tomorrow. So you really want to be careful. And also, because it's really cheap, you can put your money into it. Let's say you bought 100 shares for $250, right? You could make $172, assuming it was where we're getting the 172, so that times 100, assuming that the dividend does not change, but the stock could still drop. The stock could still drop. So you want to be very, very careful there. The second thing, actually want to pull up a different stock here. We'll just scroll down here. Johnson & Johnson, very solid dividends. They've been this way for quite some time. Again, we see the stock symbol here, J&J. We know the stock is a bit more expensive. It's $134 a share. And then we see it went up 77% or 0.77% with $1.02 from the previous close. Okay, great. Everything right now seems okay. We see here that the dividend in comparison is just 2.85%. But again, I'm getting $3.80 per share that I buy versus the dollar and what was it? The $1.72. So a lot of people go for the percentage and just say 41%, I have to get this, but you're actually making a lot less. So you want to be careful there. You also, again, want to remember for every one share that you get, you're getting $3.80. That's it. So it starts to get a little more expensive when you're trying to buy a stock for the dividend alone. And that's another part that investors get hung up on. Sometimes, I think Johnson & Johnson is a very solid stock. But if you were to jump into it thinking you're going to get rich by owning one or two shares and you only get a $4 dividend, you're going to be very upset. You may think, well, this is trash. I'm just going to leave and get out of it. You have to really understand what these dividends are and what they mean and how much you are expected to get paid. Right now, as you can see here, 85% of 134 is $3.80. That's how that works. And it's per one share. If you wanted to have $380 a year, and that's going to be still divided up for each quarter. If you wanted $380 in dividends, I'm just going to abbreviate. You guys know my handwriting is bad. You would need 134. Yeah, you need $13,000 in stock just to get $380 a year. And obviously, this number can change. It can be $379 one year. It could be $345 next year. It's going to fluctuate. But you need $13,000 to make a passive $380 every year. Not every month, not every day, not every week, every year. And that number is going to be divided by 4. So you're not going to get a check for, boom, $380 every year. So these are things I want you to be aware of when you're jumping into something. You don't just want to do it just because of dividends. Dividends can help. This extra $380, hey, that's a flight to some places, right? Like it's not nothing to sneeze at. It's not nothing to just write off altogether, but it is something to be aware of. Also, to get the 380, you got to have $13,000. If you have it, perfect. But also, is the 13,000 all of the money you have, or is it just a portion of it? So all of those things you want to put into context. And I want to show you one last thing. I know this video is a little longer than usual, but I want to educate you guys. It's a formula that you should use. And we might save this. We're going to save it because I like these to be bite-sized. So this will be part 1. I'm going to give you a part 2 on dividends and what you need to pay attention to. So right now, we know you can go to Yahoo Finance. You can find out how much the dividend is expected to be. We know the red flags that we should pay attention to with any stock, and it's kind of going to give us a warning as to whether this is going to be solid or not. And then we know how dividends work, meaning this is what we're going to get paid for every one share. So check me out for volume 2 of this dividend talk. Make sure that you hit the share button. Make sure you go to buildingbread.com, hit the free class tab to learn more about the stock market and where you should be investing. I will see you guys tomorrow. Be here. Don't be late. And obviously, it's already recorded, so you guys are going to be fine. But I'll see you guys tomorrow, and make sure you hit the share button on that as well. And then we'll continue to have this conversation about dividends. So I'll see you guys in a sec. See ya.